Good day, Market Chameleons, and everyone joining for the first time. Thanks for coming by and checking out the Market Chameleon webinar series. Before we get started, let's take a look at the shared disclaimer. Please be aware that neither Market Chameleon, Dimitri, or myself are registered investment advisors or a broker-dealer. If you're searching for investment advice, please reach out to a licensed professional. This webinar, as all our webinars, are for informational purposes only concerning Market Chameleon tools and products. With that, one last look at the disclaimer, and let's welcome Dimitri Pargamonic to the stage. He'll be talking about screening historical earnings strategy. How you doing today, D?
Good morning, Will. How are you?
All right, let me share your screen. There it is, and there's the Market Chameleon landing page. Here we go.
Thanks, Will. Good morning, everyone. And let's first navigate to our historical earnings screener, and then we'll do some examples using that screener to get some insights. So up top on the main menu, we're going to hover over earnings, and then to the right-hand side, we're going to come up to earnings option strategy screener. We're going to click on that, and this will load a historical earnings option strategy performance around earnings. And we have our filters up top and the data elements below. And what this does is look back historically for a particular stock around earnings, uses the actual options, takes a strategy, for example, straddle or a call spread or just a call or put, and tracks that strategy around earnings. Could be before earnings, after earnings, around earnings, and does that historically to get a statistics how that option strategy performed. Okay, so if we just looked at the first symbol here, it's a $36 billion market cap, and this defines the strategy, a long 25 delta call, and the tracking time period is starting 1 week before earnings and 1 day after earnings. So this is looking at close to close. If we found a 25 delta call, how did the call perform if we looked at it 1 week before and then earnings, and then looked at it at the end of the day, 1 day after earnings? Did it go up? Did it go down? And then it gives us these summary stats at the last 12 earnings. And we could click on that to get the data, but I'm going to close this for now. 33% of the time, that option was profitable, okay, from the long side. So long 25 delta call, 33% of the time was profitable. The other times it wasn't profitable. But the average return here was up 1%. Okay, so why is that happening? Well, a call option, the profitability could be unlimited. So sometimes the one time or two times that it happens to be profitable, that could outweigh, the 9 times it was unprofitable. It could be up 300%, 400%, and so on. And when it was unprofitable, it doesn't mean it lost 100% of its value. It could have been, 10%, 20%, or 100%. So the average return was 1%. The median return was negative 69%, meaning half the observations were above that, half were below. The best return was up 265%. The worst, it was down 100%, lost everything. This is the standard deviation of those returns and the Sharpe. So the idea here is we could select a specific strategy and see, well, how did that strategy perform over time? And how did maybe similar strategies perform during that same time period? Or how did that strategy perform relative to a different stock? Let's say Google versus Meta or Microsoft versus Apple, using a similar strategy. So let's take a look at a strategy we'll pick, and then we'll see what that strategy did historically to get those insights. I'm going to climb up here, and here we could see we could pick a strategy type. So let's look at the available ones, and I'm going to scroll down, and let's say we wanted to look at an at-the-money straddle. So an at-the-money straddle is buying a call and a put on the same strike, with the strike that's closest to the stock price at the money. And when you're doing that, it's not directional. You just want the stock to move in either direction to cover the cost of that strategy. So let's click on that. And now what this will do is look at the money straddles for all these historical time periods with all these stocks. You could see we had over 2.8 million different backtest results here. Now let's say we wanted to narrow this down because we have all these different ranges that we could pick from. You know, the start and end date. So let's say we wanted to look at how did a straddle perform leading up to earnings. Okay, so if you started out with a straddle, let's say 2 weeks before, how did that straddle do up to the day of earnings? So we're going to take this and say, well, we're going to do our start date 2 weeks before. Okay, so you can see here now we have all these 2 weeks before. That's the start date. So let's say you put the straddle on end of day 2 weeks before earnings. And let's say that same straddle, you wanted to end that strategy the day before earnings. So end of day, the day before earnings. Did the straddle tend to increase in price, decrease in price, stay the same? So that's a question. You know, did implied volatility or the stock movements make that straddle worth more, or did it decay over those 2 weeks? You know, even if implied vol goes up, it could have decayed and lost value. So here, now we have these results. You could see here, let's sort it by highest market cap. So if you click on these, you could sort them by market cap, any of these columns. So see in NVIDIA, a straddle 2 week hold that doesn't cover that starts 2 weeks before earnings and ends the day before earnings. That was only profitable 17% of the time with an average loss of 12%. So you could see here that a 2 week hold of a straddle was unprofitable historically on average. Apple, 42% of the time was profitable, and that one actually, you know, did a little bit better than break even. Google, 58% of the time it was profitable with an average return of 7%. And then you could see the median return, best and worst. So even with all these, you could see that we don't see any straddles that lost 100%. The worst here is 30%, 21%, 25%. But at least on the top ones, well, except maybe Microsoft, did pretty well. Actually, all these did turn out to be profitable on average. So this is one way to start looking at historical dynamics and tendencies, performance of these strategies, changing the dates around to see, well, how did this strategy perform in the past? What were the ranges, you know, best, worst, median returns, to get a sense of those market dynamics. Let's say we wanted to take a different strategy approach. Let's go back to our 25 delta call. So let's keep this the same. Let's say we do a analysis of a run up into earnings. And let's say our assumptions were historically that stocks tend to do better heading into earnings. Maybe there's a buildup in anticipation of earnings and positioning, and this could on average make the stock increase into earnings and implied volatility increase. So maybe that's good for a call option. So we're going to keep this the same, the 2 weeks before, 1 week and 1 day before, but let's just change it into a call option, right? Not a straddle, but just a call option. And we could compare that to the straddle, right? So we see what the straddle did. Let's now look at it at the money call. So now this brought us back at the money calls. So here we see NVIDIA 42% of the time was that at the money call was profitable. The rest of it was unprofitable, but it broke even on average with the worst return of 86%, best 90%. Apple 50-50 with an average return of 18%. Google 67% of the time that the money call was profitable with an average return of 36%. Microsoft 58% of the time was profitable with an average return of 36%. So here, at least on from a historical basis, it looks like the long call performed better than just the at the money straddle given this time frame. Okay, and you could do this with other types of strategies. We could keep those same dates and change those strategies to just compare if you have this assumption and wanted to see how the prices and the option dynamics played out during that time period. We could also do maybe instead of a outright call, let's say we wanted to still do a bullish lean, but we did it with a call spread. So then we could just select the call spread, and this would do a long of 50 delta call, short a 25 delta call, and then we have the percentage wins here with average returns. So I'm going to stop there, kind of give an overview of today's screener. Throw it back to you.
Yeah, that was great, D. Thanks for bringing these webinars to the Chameleon community again. We will see you tomorrow morning, hopefully.
Right. Thanks everyone for joining. Stay safe and hope to see you tomorrow.
Oh, we just had a question pop up, D, from a new Chameleon. Sorry about that. It just came through. He says, and I'm not exactly sure what an auto filter would be. Do you have an auto filter for this? He's asking. There's no such thing as an auto. I'm not even exactly sure what an auto filter would be for it, but
yeah, I'm not sure what the auto filter is.
Maybe TK, you can email support@MarketChameleon.com and let us know exactly what your thoughts are on an auto filter, how you'd want that. Just so we have an idea of what the question even means. Maybe we can get to it tomorrow. Again, great job, D, as always. And I will see you tomorrow, my friend.
All right. Thanks, everyone, for joining, and have a great trading day.
Have a great day, D. Bye. Hey, everyone. Thanks for joining another Market Chameleon webinar series. Chuck, if you have a link for that RV, please email. I'd be interested. It's an interesting looking RV. Everyone have a great, safe trading day. You can email support@MarketChameleon.com, TK, for that question if you want D to take a deeper look into it, what exactly you're looking for with that auto filter. Remember, thumbs up, like us, and also in the chat, you'll see a link to today's 4:30 webinar with Ryan Mastro from Options Robot. He always will answer just about any question you have about stocks, options, whatever it may be. If you have any questions and you're not going to be able to make the 4:30 show about particular stocks you may be interested in, put them in the chat now. Wait a couple extra seconds as I'm talking about following us on all the social platforms. If you're on YouTube right now, make sure you follow us. You'll get instant alerts to when we go live, which we try to do every trading day at 9 a.m. Nothing showing up in the chat right now to symbols. So hopefully everyone can join at 4:30. Everyone have a safe trading day, and I will see you tomorrow. Bye.